$408,800. That is the median price of a home in America right now. Not in Manhattan, not in Beverly Hills, just the middle of the country on an average Tuesday. You are lying on the couch in an apartment that costs you nearly $1,500 a month. You are doing the math, and the math just doesn't work. You've crunched the numbers 3 times this week. Same numbers, same depressing answer. You make $54,000 a year. You have a little over 11 grand in savings. Your credit score is decent, and your student loan payment hits on the 15th of the month like clockwork. The house you grew up in, the one your parents bought back in 2001 for $148,000, is now worth almost 400 grand. You know this because you check real estate apps on your phone late at night the way other people check social media. You check it the way you'd check a bruise, just to see if it's gotten worse. You tell people you're saving up. You tell yourself you're being smart. But saving at your current rate means another 4 years before you even have a down payment for a house that will probably be worth even more by the time you get there. The market is not waiting for you. It has never waited for anyone. This is exactly where most people get stuck, not because they aren't smart and not because they don't work hard. They get stuck because they're optimizing for comfort when they should be optimizing for position. The two feel similar in the moment, but they lead to completely different lives. Then, at 11:30 on a Wednesday night, you read a random forum post. It's written by some guy with no famous name and no fancy credentials. He talks about a house he bought a few years ago for $174,000. He put less than 9 grand down. He rented it out, and the tenant completely covered his mortgage. A few years later, he pulled $41,000 of profit out of that house and used it to buy the next one. You read the post 4 times. The math is not complicated. The math is almost embarrassingly simple. What is complicated is that you have spent your entire life being taught that debt is dangerous and mortgages are massive burdens. But here is this man describing debt like an engine. Something in your mind shifts. It isn't just a feeling, it is a completely new framework. Rule number 1. At 0, your obstacle is not money. Your obstacle is that you think like a renter. Renters look at real estate entirely as a cost. The moment you start seeing it as a vehicle for wealth, the entire road changes. You start studying your city's real estate market the way you used to study for college exams, except this time you actually care. You learn about profit percentages. You learn how fast cash pays itself back. You learn the specific financial ratios that banks care about and why the income a building generates matters way more to a lender than your standard paycheck. You learn the difference between a luxury apartment building in a wealthy zip code making a small, safe return and a working-class rental a few miles away generating massive profit. You aren't ready to buy either of them yet, but you finally understand. And understanding is always the first purchase you make. Then, on a Saturday morning, you find the property. You don't find it online. A coworker mentions it casually in the break room. Her aunt is selling a brick duplex. She just wants to be done with it and needs to close before the end of the year. It's in a working-class neighborhood that has been quietly improving for 2 years, just a few miles from a hospital that announced a massive expansion. She is asking $218,000. Both units are already rented, bringing in over $2,100 a month. You run the numbers on a napkin in your car. You run them again on a spreadsheet at home. You try to talk yourself out of it for 4 days. Then you make the call. You put 20% down, $43,600. It completely wipes out your savings account. You feel the way people must feel right as they jump out of an airplane, absolutely terrified, yet completely awake. Because you're not living in it, the bank gives you an investment mortgage rate slightly higher than a normal home loan. Your monthly payment is $1,174. Your renters bring in $2,100. After setting aside money for taxes, insurance, and emergency repairs, you clear nearly $500 in pure profit. It is not life-changing money. You know it's not life-changing money, but you also realize something profound. Someone else is paying your mortgage every single month. Two people you have never met are quietly building your net worth, one payment at a time. That feels entirely different than a paycheck. You do not quit your day job. You do not brag to everyone you know. You do not start a flashy podcast. You just quietly deposit the rent. You fix a water heater when a tenant calls at 7 p.m. on a Thursday. You learn basic plumbing. You learn that hiring a property manager will eat up 10% of your profits, and at your current size, you cannot afford to hand that margin away. So, you manage it yourself.
Every single problem teaches you something textbooks never could. The appliance that breaks on Christmas Eve, the tenant who always pays 2 weeks late but always pays, the neighbor who complains about overflowing gutters. These aren't just headaches, this is your tuition. 18 months later, the duplex has gone up in value. Nothing dramatic, just a steady climb. The neighborhood became exactly what you predicted. A coffee shop opened on the corner, then a gym, then a small brewery. The hospital expansion broke ground. You check your property value online, but with completely different eyes this time. It sits at $261,000. You now have 46 grand in pure equity. The cash flow keeps rolling in. You've managed to save another 14 grand from your day job. You are 29 years old. Your net worth is $68,000. 2 years ago, it was zero. Rule number 2. The house someone else pays for is the only house that makes you richer while you sleep. Everything else you own is just expensive furniture. You refinance the duplex and pull out $28,000 in tax-free cash. It increases your monthly payment slightly, and your stomach drops the way it always does when moving large amounts of money. But you understand what that guy on the forum understood. You are not spending this money. You are strategically repositioning it. You use that cash as the down payment on a single-family rental house in the suburbs. You spend the 3 months before closing making yourself the perfect borrower, paying down credit cards, managing your accounts perfectly, looking at yourself exactly the way a bank would. You close the deal. You now own 3 units. They bring in nearly $3,600 a month. Your total mortgages are just over $2,000. After emergency reserves and insurance, your real estate pays you $847 a month. Your day job still covers your living expenses. Your real estate is entirely separate. It is a quiet machine you are building in the background, and it runs whether you think about it or not. But you start thinking about it constantly. You are 31. Your real estate portfolio is worth almost $500,000. Your pure equity is over $150,000. The number feels unreal. You check it the way you used to check your empty bank balance at midnight, not out of anxiety, but out of absolute disbelief. You spent your 20s watching the median home price feel like an unscalable wall. Now you're sitting on 3 times that amount in equity, built in just 5 years by making decisions that other people called too risky. You still drive the same car. You eat lunch at the same places. Nobody at your office knows anything about this. You have realized that talking about wealth makes people act strange. They either want a piece of it, or they want to explain to you why your success won't last. Neither conversation helps you, so you stay completely quiet. Then you find a 6-unit apartment building, fully rented. You do the math, and the profit margin is far better than the national average. You spend 6 weeks investigating the property from every possible angle. You find expensive flaws the seller tried to hide, and you use them to negotiate $38,000 off the asking price. You partner with a private lender who puts up the cash. You spend 8 months building a relationship with them over coffee and dinners without ever asking for a dime. Now they make a safe 9% return on their money, and you get a building. Everyone wins. This specific transaction completely changes the texture of your life. Before this, you were just a person who owned a few rental houses. After this, you are officially operating a commercial real estate business. The financing is different, the insurance is heavier, the management is entirely different. For the first time, you hire a part-time property manager. She pays you $340 a month, and she is worth 3 times that. Rule number 3. Below 5 units, you are a landlord. Above it, you are building a business. The moment it becomes a business, your leverage changes. The way banks look at you changes. Your combined portfolio now generates over $7,000 in rent every month. After all expenses and management fees, you are clearing over $2,000 in pure profit. For the first time, your side income crosses 5 figures in a single year. You file your taxes entirely differently now. You hire an accountant who specializes in real estate. She introduces you to advanced tax strategies, showing you how the government actually legally rewards you for owning property. The massive amounts of money you save on taxes go right back into the machine. You are 34. You own 9 units. Your total real estate holdings are worth over $1 million. Crossing the $1 million mark hits your chest like a heavyweight fist. You don't feel pride, you feel the immense weight of it, the weight of having built something incredibly real, something that started as an idea on paper, turned into brick and mortar, provided homes for real people, and eventually became a number you once thought was mathematically impossible. You feel all of that heavy reality, and then you get right back to work.
A massive 24-unit apartment complex comes across your desk. A developer overextended himself and needs cash immediately. The property is in a booming secondary market where remote workers moved and never left. The asking price is nearly $3 million. You know this market so well that you can recite the numbers without looking at your notes. You know that with just 2 simple operational changes, you can push the occupancy rate to near perfect and dramatically increase the value. But you cannot buy this alone. You have never pooled investor money before. So you spend $4,000 on a specialized attorney to make sure it's done legally. You bring in 3 investors from your quiet, carefully guarded network, people who have capital but no time. They trust you because you didn't tell them you were successful. You proved it over the last 4 years. You raise nearly $700,000. You close on the 24 units. You are the lead operator. You are a completely different human being than the one who was terrified to call a woman about a brick duplex 6 years ago. Rule number 4. The deal you get into matters far less than the terms you negotiate to enter it. Equity, cash flow, and control are 3 entirely separate things. Amateurs think they want cash flow. Professionals know they want control. Understanding that difference is the exact line between building simple income and building generational wealth. By 37, your portfolio holds 47 units. Your annual profit from real estate clears $148,000. Your side hustle has officially surpassed your salary. You don't make a big announcement on social media. You just tell your spouse on dinner on a random Tuesday. She already knew it was coming because she watched you run spreadsheets every weekend for 7 years. That night, you sit at the dinner table and have a 3-hour conversation about high-level capital allocation. You discuss which properties to sell and how to manage debt in a shifting economy. It is one of the most important conversations of your entire life, and it happens quietly in a house where nothing outwardly remarkable is happening. That is what real wealth looks like. You finally sell your very first duplex, the one that started it all.
You sell it for over $300,000. You use a legal tax loophole to completely bypass capital gains taxes, rolling your massive profit directly into a 32-unit building in a market you know is severely underpriced. You are buying time just as much as you are buying real estate. Your net worth shatters the $2 million mark. It lands differently than you expected. It doesn't feel like a grand arrival. It just feels like a checkpoint on a much longer road. You start running in circles with people who operate at a completely different altitude. Not internet celebrities, true quiet operators who own hundreds of units. You watch exactly how they think. They move at a different pace. They have endless patience. They analyze deals years before those deals ever go public. They build relationships with sellers before the sellers even know they want to sell. You step up to their level. You raise a multi-million-dollar fund from investors who have watched you execute flawlessly for over a decade. You buy massive apartment complexes. You hire a full-time asset manager. You integrate heavy corporate software. The line between being a solo investor and a business operator completely vanishes. The weekend project is now a legitimate institution. Rule number 5. At $10 million, your reputation becomes your greatest financial instrument. Brokers start bringing you lucrative deals before they even hit the open market. Lenders actively call you. Sellers happily accept your offer over a higher bid from a stranger, simply because they know you actually close. That level of trust cannot be purchased. It is built, one kept promise at a time, over a decade of grinding in the dark. At 43, your portfolio holds over 200 units across 4 different markets. Your total asset value is over $30 million. Your personal net worth is over $14 million. Exactly 3 people know that figure: your spouse, your lawyer, and your accountant. That's it. You have completely stopped measuring yourself by the money, not because it doesn't matter, but because the number itself is no longer the interesting part. The strategy is the interesting part, the velocity of the money, the way you can move capital to magically create options out of thin air. You dive into a 300-unit ground-up development deal. You have never built from the dirt up, so you hire experts who have. You learn more navigating brutal city politics and zoning laws in 18 months than you did in the previous 5 years combined. You lose 6 months to a bad city council vote. You don't panic. You redesign, represent, and completely win. The building launches and is almost instantly fully leased. The very same city council that fought you is now using your gorgeous building in their promotional brochures. You don't feel smug or vindicated, you just feel focused. There is already another massive deal sitting on your desk. You exit older properties, strategically moving millions into specialized real estate trusts and industrial conversions. You make cold, calculated decisions based purely on hard math. You realize prestige is only for people who are still trying to impress someone. You stopped caring about that the day you cleared your first million.
You pay yourself over $1 million a year, but you pump almost all of it directly back into the machine. You still live in the same house. You drive the same reliable truck. You take your family on one incredible trip a year. Living quietly is a choice, not a constraint. And the difference between those two realities is the entire point of everything you've ever done. Rule number 6. Above $50 million, you are no longer an investor. You are infrastructure. Cities literally plan their futures around you. Major banks invent custom financial products specifically for you. The market doesn't look at you, it incorporates you. You are 51. You control 700 units. Your total real estate empire is worth $87 million. Your personal net worth sits at $52 million. You have a massive staff, an acquisitions director, an in-house CFO, and multiple operating funds.
You sit in quiet boardrooms with people who collectively control billions of dollars. The conversations are incredibly short. The decisions are lightning fast. The money moves in massive sizes that would have seemed completely fictional to the younger version of you staring at a phone on a rented couch. But you still make time to mentor a few hungry 27-year-olds who remind you of yourself. You don't feed them generic motivation. You feed them raw math. You show them the actual, terrifying numbers from your very first duplex, the $1,100 mortgage, the small profit margins. You explain the absolute terror and immense pride of handing over the keys to your very first tenant. You show them the gritty spreadsheets from your early negotiations. You teach them the brutal truth that nobody else talks about. Real estate heavily rewards the specific. The person who obsesses over one single market, one specific type of asset, and learns it until they can navigate it in the dark, that is the person who will own the city in 20 years. The person waiting around for the perfect economic conditions has been waiting their entire life. Right now, somewhere in your city, there is a 27-year-old lying on a cheap rental couch. Their apartment costs them nearly $1,500 a month. They are scrolling through real estate apps, looking at a median-priced home and running the math that just doesn't work. They are telling themselves they are being smart, they are waiting. But the moment is never going to get more perfect than it is right now. Interest rates fluctuate. They might drop, they might skyrocket. The market is not pausing for anyone's savings account to catch up. The question is not whether the timing is perfect. The question is what the next 20 years of your life will look like if you keep waiting for permission to start. The wealth machine does not run on confidence. It does not run on inspiration. It runs entirely on the very first, terrifying, hyper-specific decision you make. A simple duplex, a phone call you almost talked yourself out of, a down payment that takes your bank account to absolute zero. Because after that, someone else starts paying your mortgage. After that, the math starts compounding in your favor. After that, you finally understand what the word asset actually means. A machine built by your own courage that generates freedom on a random Tuesday afternoon while you are doing something else entirely. $408,800. It always starts exactly there, and it always will.